Three Indian companies are exploding in growth right now, and most investors have no idea how big this could get. Everyone wants to spot that giant before it becomes a giant. But hypergrowth stocks are not random. They follow a predictable pattern. Today, I am breaking down the exact 10-point checklist I used to filter next gen 100x style. And I have already tested these three companies against it. Stay till the end because one of them scored far higher and far riskier than even I expected. Now first let's see the 10-point growth stock checklist. Before we judge any company, we run it through one simple filter. The 10 traits that almost every next-gen hypergrowth stock has in common. And here's the twist. If a company meets at least 7 out of 10, it becomes a serious candidate. Miss more than 3, I immediately lose interest. Let's break it down fast. The first one, revenue growth. A real growth stock must grow sales year after year. No excuses, no flat quarters, no stagnation. The next one, expanding market. The company should be sitting in a market that's getting bigger because even the best business can't grow if the market is shrinking. The next one, strong unit economics. Every order, customer or transaction should make sense financially. If they lose 20 rupees to earn 10 rupees, that's not growth. That's charity. The next one, tech edge or differentiation. What makes them hard to copy? Tech, data, speed, brand, something competitors can't replace overnight. The next one, leadership quality. Hypergrowth needs a leader with vision, not someone reacting to competitors. This matters more than people think. The next one, execution speed. Great ideas don't win fast, execution does. The company should scale quickly when the opportunity shows up. The next one, path to profitability. Even if they are not profitable today, there must be a clear, visible roadmap to get there. The next one, moat. Brand strength, distribution, scale, network effects, something that protects the company when competition attacks. Next, balance sheet strength. Too much depth, nothing but limited growth and high risk. A clean balance sheet gives firepower to expand. The last one, future narrative, 5 to 10 years. Does the company's story make sense for India's next decade? If not, it won't survive long enough to compound. If a business hits 7 out of these 10, it's worth studying deeper. Hit 8 or 9, you may be looking at a future giant. And yes, one of the companies actually hits 9 out of 10. Okay, now that you know the checklist, let's test it on the first company. And the results might surprise you. Remember, this is not advice. These are facts, frameworks, and signals for you to research and decide with confidence. Now let's see stock number 3, Zomato. Zomato ticks many of our boxes. Over recent years, its food delivery business together with quick commerce and delivery platforms has seen strong growth as India's consumption economy and online ordering expand rapidly. That demonstrates high revenue growth and a growing market potential because more Indians are using smartphones and ordering food or groceries online. The underlying market, both food delivery and quick commerce, remains underpenetrated and likely to expand further. On unit economics, while early losses existed, Zomato's core food delivery business has moved toward profitability, and incremental scale along with best cost control seem to be improving margins. Their tech, data, logistics edge gives them advantage. Managing deliveries, predicting demand, optimizing routes, something many small players can't easily replicate. Leadership remains focused on growth, experimenting and expanding into newer verticals or cities, showing execution ability and willingness to scale fast. Zomato's path to profitability looks plausible. As core business profits stable and newer verticals mature, the company may become sustainability profitable. Also, with large network effects, customers, restaurants, delivery partners, Zomato builds a moat which is difficult for new entrants to breach at scale. On the financial side, it does carry some debt. Public data suggests total debt is non-zero, so its balance sheet cannot be called debt-free. That means debt and financial risk must be watched carefully. Finally, the future narrative and investor interest remain strong. Consumers shifting online, rising convenience demand, and India's growing consumption story all give Zomato relevance. But with high expectations comes high volatility, and competition remains a threat. In sum, Zomato meets many of our criteria: growth, market, tech edge, execution, but death and volatility are real risk. Now let's see stock number 2, Chola Finance. Chola Finance is different from a tech or consumer internet firm. It's a well-established non-banking finance company operating in vehicle finance, retail, and other loan segments. Its appeal lies in steady growth, strong fundamentals, and familiarity with India's credit demands. Chola has shown consistent growth in operations and financial performance. Its asset under management AUM have grown significantly in recent years, reflecting rising demand for vehicle loans, home equity loans, and personal credit. This demonstrates market potential. India's credit penetration remains relatively low, so there's headroom for expansion if the economy and consumer demand stay healthy. On unit economics and profitability, Chola has historically delivered stable returns. Their business model, diversified loan book, careful credit underwriting, and risk management ensures that margins remain reasonably healthy and defaults manageable. Next, leadership and corporate governance for Chola are well established. The firm has decades-long history, a large branch network, and disciplined operations across different loan categories. This suggests stable management and execution capability. Regarding balance sheet health, as a financial company, some borrowing is natural, but available data and ratings suggest that leverage is within the manageable levels without excessive risk. Chola's competitive moat is moderate. It is primarily built on brand, network of branches across many states, and relationships with customers and dealers. They may protect it to some extent, though the lending sector remains competitive. As for its future narrative, as long as India's economy grows and credit demand rises, Chola stands to be benefit. However, macroeconomic headwinds, interest rate fluctuations, and credit cycles could affect growth or asset quality. In sum, Chola meets many of our growth stock criteria. Being a finance play, it is more of a stable compounder than a high growth disruptor. It's a good pick for those who prefer steady growth over high volatility. Now let's see stock number 1, Polycab India. Polycab India operates in a very different space altogether, manufacturing wires, cables, electrical components, and related products. It is among the market leaders in this segment in India. Its recent finance shows solid performance. For fiscal year 2025, Polycab reported around 24% rise in revenue. It is among the market leaders in this segment in India. Its recent financials show solid performance for fiscal year 2025. Polycab reported around 24% rise in revenue and healthy growth in profits, reflecting good demand and efficient operations. The market Polycab serves: construction, real estate, infrastructure, urban electrification, renewable energy wiring, and growth in housing is large and expanding. With urbanization, infrastructure development, real estate activity, and growing electricity, solar, EV penetration in India, demand for wiring and cables is likely to continue rising. That offers a large addressable market TAM for Polycab. Polycab appears to maintain good unit economics and profitability. From basic wires to industrial cables and electrical goods, gives it flexibility, and its scale helps achieve economics. Also, as a leader in its segment with a broad distribution network and manufacturing reach, Polycab enjoys a competitive moat over smaller local players because scale in manufacturing, procurement, and logistic makers entry harder. The company shows healthy financial discipline. Its debt levels are relatively modest compared to overall operations, suggesting manageable financial risk. Its leadership and corporate history reflect stability, and over past quarters it has delivered consistent results, showing execution capability. The narrative for Polycab is pragmatic and long term. As India keeps building houses, infrastructures, upgrading electricity networks, and pushing renewable energy EV adoption, demand for wires and cables will persist. This gives Polycab a quiet but steady growth story. However, raw material cost fluctuations like copper price, input cost inflation, cyclicality in construction or real estate market, and competition from unorganized or cheaper players remain downsides. Yes, Polycab trades at a higher price today, but its deep moat, strong fundamentals, market leadership, and growth tailwinds make the premium understandable if you are investing long term. Treat it as a quality growth stock with premium valuation, not as a hyper low price multi-bagger bet. And maybe wait for a dip or invest in tranches. Don't blindly buy at a peak because overpaying reduces margin of safety. And that's my clear no hype breakdown of these 3 Indian companies using the 10-point checklist. Each one has potential, but each one carries its own risk. So treat this as a starting point, not a guarantee. Your own research and valuation check matter the most. If this video gave you clarity, hit that like button and tell me in the comments which company impressed you the most. This is Bala signing off.